So that's our new topic, mergers and acquisition. I had shared with you some the handout. I had shared the handout. Yeah, half of this topic will be discussing on what we have the handout, that's the theories, and then the other part will be the computations. Yeah, so let's look at evaluation of mergers and acquisition. Yeah, before we discuss, let's write some notes. Ready to see that? Okay, before you write, what's the difference between a merger and acquisition? A merger and an acquisition. Now, for mergers, this is where the two companies they come together to form a new company. And in this case, the old companies, they lose their identity to form a new identity. But in acquisition, it's also known as the takeover. And takeover, this is where one company, known as the predator, acquires another company. That's what we call the target. Now, in this case, for the acquisition of the takeover, now the target loses the identity, but the predator retains its identity. But the thing in mergers, the two companies, that's A and B, they join, and then they'll now a new company. Let's call it C. Now, what happens? The old company, they lose their identity, and then they have a new identity. But for acquisition, the predator retains its identity, but the target loses its identity. Yeah, we ready to see that? Like to see that? After the acquisitions, comma, the EPS, that's the earnings per share, the EPS of the surviving company, the EPS of the surviving company, in bracket predator, will be determined as follows, based with the nature of the consideration, based on the nature of the consideration. Yeah, so number A, in case of share for share exchange, in case of a share for share exchange, so how do we get the post-acquisition? Post-acquisition EPS of the predator. Now, predator will be the surviving company. So we'll take the combined earnings. Yeah, that's for both the predator and for the target. And then you divide by the number of the predator's share plus new shares to be issued. And then number B, in case of a debenture issue, so in case of debenture issue, how do we get the post-acquisition EPS of the predator? So you'll take the combined earnings then you raise the interest, and the interest should be the net of tax. And then you divide by the number of the predator's share. Number C, in case of preference share, so how do we get the post-acquisition EPS of the predator? So we'll take the combined earnings then you deduct the preference dividend All of it you divide by the number of the predators share. We right to say that? We right to say that? The number of new shares to be issued, the number of new shares to be issued, the number of new shares to be issued depends on the exchange ratios, depends on the exchange ratios, depend on the exchange ratio, depends on exchange ratio. Good. So how do we determine the exchange ratio? What we call the non-diluting exchange ratio. Now, to get an non-diluting exchange ratio, you'll take the offer price by the predator, you divide by the market price per share of the predator. And how do we get the non-diluting offer price? To get the non-diluting offer price, you take the price earning ratio of the predator, you multiply by the earnings per share of the target. How do we get the price earning ratio? To get the price earning ratio, you take the market price per share, you divide by the earnings per share. How do we get the share premium? To get the share premium, you will take the offer price, you compare against the market price per share of the target. And how do we get the post-acquisition? Post-acquisition MPS of the predator. So to get the post-acquisition, we take the price earning ratio of the predator, then you multiply by the post-acquisition earnings per share of the predator. So now, before I do some illustration, now let's discuss on some theories on mergers and acquisition. So take out your notes, or you take out your handout page 24. Handout page 24. I had also shared the notes. So in case you had printed the notes, you can also use the notes. It's the same content. The notes of the handout. So we discussed on mergers and acquisition. So what's a merger? I think I had discussed what's the difference between a merger and acquisition. And we said that a merger is a combination of two or more equal companies to form a new entity. And in this case, the original company will lose their original identity after the other, and none of them will dominate the other. Now, that's in a merger. What about in an acquisition? Now, acquisition is also known as the takeover, is a situation where one company known as the predator acquires the other company known as the target. Yeah, and after the acquisition, the target will lose its identity, but the predator will maintain its identity. Yeah, that's the difference between the merger and an acquisition. Yeah. So here the key thing is that under mergers and acquisition, there's always be one company known as the predator, and the other one is the target. Yeah. So we have various types of mergers and acquisition. Types of mergers and acquisition. And they are classified into four. Number one, we have what we call horizontal merger. Number two, we have the vertical mergers. Number three, we have conglomerate mergers. Then number four, we have the concentric or congeneric mergers. And what's the difference between the four? Now, for horizontal mergers, now this is where the two companies, same industry, same level of production, they merge. Same industry, same level of production. That's what we call the horizontal merger. Then we have the vertical merger. Now, for vertical merger, this is where the two or more companies, they're in the same industry, but in different levels of production. So remember, horizontal, same industry, same level of production. Vertical merger, same industry, but different levels of production. Then we have conglomerate merger. Now, conglomerate merger is where the two companies which are unrelated, that means they are not from the same industry, they merge. So for conglomerate, the major objective is for risk diversification. Risk diversification. Yeah, because we are saying that for conglomerate merger is where the two companies from different industry, they merge. Then lastly, we have the concentric or congeneric merger. Now, for congeneric merger, now this is where the two companies which are unrelated, that means they are from different industry, they merge. But in this case, we are saying that the two companies, they are from different industry. That means they are offering different product, but they have the same target customer. They have the same target customer. So that means they make these two companies to be an indirect competitor. Yeah, how is it indirect? It's not direct because in this case, we are saying that they're offering different products. That means they're in different industry, but they have the same client, good, or same customers. Good. So now let's evaluate that. We are saying that horizontal merger, this is the combination of two or more companies in the same line and type of business. And the main purpose of horizontal merger is to improve on the market share of the two companies. Yeah, so try to consolidate their market share. E.g., ICA and Ryons were all insurance companies before they had merged. Then number two, we have the vertical merger. We're saying that in vertical merger, this is a combination of two or more companies which are in different level of production, but in the same industry. The same industry, but different levels of production. E.g., a vehicle assembling company with a tire manufacturing company. And then number three, we have the conglomerate merger. So for conglomerate merger is the combination of two or more companies which are unrelated. Can you underline unrelated? If you're unrelated, that means they're in a different industry. Yeah. So they are from different industry and different level of production. And the major purpose of this is for risk diversification, e.g. Samia group of company. For the Samia group of company, they usually do buy or merge with companies which are offering different products. And the objective is to minimize on risk or for risk diversification. Then number four, lastly, we have the concentric or the cogeneric merger. And this happens when the companies merge with another company in different industry that sells product to the same customer. Different industry that sells the product to the same customer, though they sell different products, making them indirect competitor. Yeah, for example, it's like, for example, you have a canteen, a school canteen, owned by an individual. Now, in this case, the school canteen and us as a school, are we in the same industry? We are not in the same industry, right? Yes, for us, we're an academic institution. What about them? They know what? They are retail. You see retail. Food industry in food industry. Yes, you see in that case we're in a different line of production. But who are the major customers? Students. So for us, the customer are the student. Even for them, the customer are the student. Yeah, that's what we call now a congeneric or the concentric merger. So now let's look at for some of the reasons for merger and acquisition. Why do the company need to merge, or why do a company need to buy another company? Number one, the major objective is for risk diversification. But for risk diversification, the major type of merger is the conglomerate merger. If you want to diversify your risk, yeah, don't go to the company within the same industry, because if there is a change in the industry, it will affect the entire industry. So therefore, you have not minimized anything. So there, the good thing, the best type of merger and acquisition for this diversification, it's only the conglomerate merger. So you're saying that, especially for conglomerate merger, where two companies merge, forming a portfolio that will maximize return and minimize on risk. Then number two, another reason is for asset acquisition or asset backing. Yeah, and that's a very major. Now, mostly for manufacturing company, yeah, you may have a machine, a manufacturing machine that's too expensive, which might cost even 500 million, of which for one company to acquire this, it must be heavy for them. But in this case, what if they merge? You buying a plot alone and buying as a chama, which one is easier to acquire the plot? Chama, yeah, because you have come together. Yeah, that's another objective of having mergers and acquisition. So you're saying that where a merger takes place or an acquisition, the assets of the other company belong to the same group of company. And this makes it cheaper instead of purchasing new assets that include also which include also the human resource. Number three, we have what you call the asset breakup value. Yeah, what do you mean by asset breakup value? Now, this is what happens. Here we have company A, they merge with company B, or company A acquires company B. And in this case, company A had 5 distribution vehicles. Company B had 4 distribution vehicles. Now they merge. So that means if you merge, how many in total do we have the distribution vehicle? We have now. If you merge, do you require all of the 9? All the 9? No, you don't require all the 9. If you merge or you become one, if you had 10 accountants, the other company had 10 accountants, then you merge, will you still maintain 10 accountants? Why? Because that will be duplication of what? So in this case, what happens? The company A and company, mostly the predator, now instead of having all the 9, they might decide to retain only 7. Then they sell the remaining 2. So what will happen if they sell? They realize more cash flows, right? Realize more cash flow. What happens to the company now? In this case, the company can be able to realize more cash flow for operating activity. That's what we call the breakup value. And you're saying that this is where the predator acquires the target and starts selling the assets of the target to realize more value. Yeah, that means the objective was to increase the liquidity, because if you dispose some assets, in that case, we improve the liquidity of the company. Then number 4, another objective is for empire building. Number 5 is tax savings. Yeah, actually, the company, mostly when they're in the process of merger and acquisition, there is a lot of tax advantages. Yeah, they have a lot of tax exemptions. Number 6 also is for management acquisition. Number 7 is for defensive merger. Also financing and liquidity. Also number 9 is synergy. Actually, that's the major objective. Synergy. What do you mean by synergy? Now, synergy is what we call the addition of benefits. Yeah, which arises as a result of economies of scale. Economies of scale. And how does the rule of synergy apply? The rule of synergy. 1 + 1 is equals to what? 2. Not academic. Tunasema now under the rules of synergy. 1 + 1 is equals to 10. Yeah, in synergy, 1 + 1 is equals to 3. And 2 + 2 is not 4. Is greater than 4. How does that work? Now, this is how it works. If 2 companies, company A and company B, they merge. Company A, assume that was reporting a profit of 100 million annually, and company B was reporting 80 million annually. And then they merge. So how much will be the total profit if they merge? 100 and 180. That's not correct. Yeah, it's 180 per se, but it will not be 180. Why is that the case? Let me move back where I was giving you an illustration about distribution vehicle or the account department, where company A had 10 accountants, company B had 10 accountants. If we merge, what will happen? There will be layoffs, because we are merging so that we can save on cost. So if we merge, we don't require all the 20 accountants. High chances we might only retain 15 accountants. So what will happen to the 5? The same, we had 5 distribution vehicles. Company B had 4 distribution vehicles. So in total, they had 9. After they merge also the distribution system. So that means they don't require all the 9. So what will happen to the maintenance cost and the running cost of those motor vehicles? Will it go up or we go down? We'll go down. So if it go down, that means the company will realize the cost savings. What's the effect of the cost saving to the profit? If we save on cost, the profit will increase. It increases. So that's why you're saying that in this case, the profit will not be 180. Yeah, due to that economies of scale, there will be more cost saving, and the cost saving will realize more profit. So that's why you're saying that under the rules of synergy, 100 + 80 is not 180. That's why you're saying that 1 + 1 is not equals to 2, is equals to 3. That's what we call the synergy. So now let's discuss on that. They're saying that synergy, this is the additional benefit associated with the economies of scale after merger and acquisition. Synergy is divided into 4 as follows. So we are in page 25. Number 1, we have the operational synergy, and this will result from the economies of scale and complementary resources, which can be shared among the two companies. Then we have managerial synergy, and this results from the combination of the management teams. Also, you have the financial synergy. Yeah, this will lead to decrease in the fluctuation of cash flows and cost of borrowing. And then also you can have the combination of the three. And that's the combination of operational, managerial, and financial. Yeah, those are the 4 types of synergy: operational, managerial, financial, and combination of the three. Good. Now, synergy is not always achieved in practice, but not always, due to the following reason. You see that synergy is that additional benefit you expected. So sometimes that additional benefit expected might not be realized. Now, what are some of the reasons for that? Number 1 is lack of complete information before the mergers and acquisition. Yeah, during mergers and acquisition, you need to engage the experts. And when you engage the experts, you also need to do a deep due diligence of the company you're about to acquire. If you don't engage experts, you'll be surprised. Yeah. Then number 2, inability to accurately take and measure synergy. Also, another reason is because of being too optimistic about the potential benefit of the merger and acquisition. Also, lack of motivation on the part of managers to achieve additional benefits. Also, because of payment of high premium on the acquisition of the target. Yeah, and that's another reason. Because this is what happens. Company A acquired company B. First of all, you have, before you buy company B, you have to do what you call the corporate valuation. The company you are buying, how much is the current market value? Now let's assume that company B, based on the current value or its net asset, is worth 500. But in this case, company A did not carry a well due diligence and better corporate valuation because they didn't engage experts. So for them, instead of paying 500, they paid 700 million. But you see, the company being acquired is worth how much? 500. So in this case, they have paid an addition of 200. Now, this 200 is what we call now the value gap. And the value gap to the company buying the other company in financial reporting is what we call the goodwill. The difference between the purchase consideration and the net asset acquired. That will be the goodwill. But for the company being acquired, to them is a premium, which is a profit. Now, in this case, we are saying that they have overpaid by 200. But we are saying that the major objective of merger was to do a cost saving. But in this case, in the process of saving that cost, you paid more. So that means it might take even a longer period to recover the 200. So, and that 200, we are saying that that benefit you expect is what we call the synergy. So due to higher payment of high premium, you might not achieve that synergy. That's why we're saying that because of the payment of high premium on acquisition of the target. And then lastly, integration problem, such as cultural differences. Yeah, you know, company is another person at the eyes of the road. Yeah? If the two companies merge, how company A used to work and how company B used to work, they were totally different. Sometimes to integrate so that they can work as one, sometimes might be a problem. How many are chairman? Yeah? Can you assume now, for example, we merge KCE, we merge with another college. Yeah? Or let's assume you have been working with the government. You know, for government, you don't go to work on weekends, yeah? On holidays. Then you come here to KCE. Yeah? On holidays, we are here. Weekends, we are here. Yeah? You see, sometimes it might be difficult for you because for you, you are used. On weekends, that's my time. Holiday, it's my time. Then we merge with the KCE. Now KCE, you have to work from Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, and Sunday. So sometimes it becomes a challenge. That's what we call the integration problem. Good. So there are steps used in mergers and acquisitions. So we'll go through that. That's very simple. Now let's look at what we call the hostile takeover. We see that takeover is the same as acquisition. But in this case, we are having what we call a hostile takeover. Now, who passes it's called what? Okay, for us to have a mergers acquisition, does it require a general resolution or a special resolution? Special, that 75%, right? Who votes? Who makes this decision? Are they the management or the shareholders? Shareholders, good. They are shareholders. Now, shareholders are the one who effects these mergers and acquisition. Now, in this case, the shareholder are tired of the company. You have not been paying the dividends. So they have decided to sell it to the predator because they have given a good offer. But in this case, who runs the company? The management of the directors. Are you together? Now, you as a director, what can you do to save the company from that hostile takeover? Hostile takeover, that means that in this case, the shareholder have decided. But in this case, the predator is taking advantage of that. They are taking advantage of that. So that means the strategy, the predator wants to acquire the target is not compatible with. That's what we call a hostile takeover. They are not in the terms of the strategy of acquisition, they are not compatible. So that's what we call the hostile takeover. And they think that this is where one company known as the predator takes over the target. And in this case, the target would be unwilling. The target will be unwilling on the takeover strategy. Now you can ask, if they are unwilling, why do they don't they withdraw? But you think that this is not a decision to be made by the management. The decision to be made by who? Shareholders. Yeah. So in that case, so what are some of the indicators of hostile takeover in a target company? Yeah, some of the indicators. Number one is the resource mismatch hypothesis. Yeah, that means in this case, the target has potential of growth, but they don't have resources. But for me as a predator, I have what you need. So what will happen? I always take advantage of you, true or false. You need something, and you don't have other means of having that. And I know what you need, I have it. So high chances you have to go with my terms. That's what we call the resource mismatch hypothesis. And we're saying that in this case, the target company will have a potential of good performance, but due to unavailability of sufficient resources, the company becomes an easy target for hostile takeover. Number two is the size hypothesis. And in a highly competitive market, bigger company will easily take over small company. And when a company is smaller in size, then it becomes an easy target for a hostile takeover. How do you measure the size of the company? How do you measure the size of the company? Is it the number of employees? Is it popularity? Is it profitability? How do you measure the size of a company? Kochong, you're saying something. Yeah, correct. You measure the size of the company by the asset base. Yeah, you don't look at the size of the company from the income statement, the profit. You look at it from the statement of financial position. And that's the asset base. You look at the equity long-term debt or the net asset minus the current liability. That's how you measure the size of the company. Then number three, we have the price earning ratio hypothesis. Number four, you have industrial disturbance hypothesis. Also management inefficiency hypothesis. So what are some of the strategies to avoid a hostile takeover? Yeah, when a target is exposed to hostile takeover, what are some of the strategies? Now, not as a company, but you now as a management, can you do to try to scare away the predator? Those are what we call the strategies to avoid a hostile takeover. Number one is the sale of crown jewel. Yeah, the sale of crown jewel, this is where now the management of the company, they are the one running the company. Once they become a victim of hostile takeover, before that process goes on, they start selling most of the attractive assets. Once they sell most of the attractive assets, they remain like a skeleton. Now, as a predator, will you buy a skeleton? No. So in that case, the predator backs down. But in this case, it was just a strategy. So you're saying that this is where the target company would sell the most attractive assets, leaving them a skeleton and unattractive. Then number two, we have what we call use of Pac-Man defense. Pac-Man defense. That's giving what we call a counter offer. Kama ambia mtu nitakupiga, naye akwambia upige nani? Mimi nitakupiga. So what will you feel? How will you feel? Naenda kuthreaten mtu naye anakuthreaten. Yeah, that's what we call the Pac-Man defense. So you're saying that in this case, the predator gave an offer to target. Then target naye anajijaza anamwambia hata mimi naweza kukununua. Yeah. So in that case, as a predator, you just back down. You just back down. That's what we call the Pacman defense. You're saying that this is where the target gives a counter offer to acquire the predator. Lakini jua hawana pesa, sawa sawa. Ile tu kufanya nini? Kushtua tu, eh? Yeah. This is where the target gives a counter offer to acquire the predator, and in the process, the predator would back down because of the threat of being taken over by the perceived small company. Good. Then number 3, we have what we call the use of white knight or white square. White knight or white square. Now, this is where, let me try to illustrate using a diagram here. Here we have company B, now which is the target. But now being a target, there are several predators. We have A, we have C, we have D. So in this case, what happens? The use of white square. Now in this case, we have no alternative. It's upon you now to look between A, C, and D, who looks like an attractive predator. Here you have no others. But now it's upon you now to choose who will be an attractive predator. So it's upon merging with a friendlier predator. But they are different. Eh? White knight, okay, it's the same strategy. But for white knight, you look for a predator who will acquire the entire business, 100%. That's what we call the white knight. White square is the same strategy. You look for a friendlier predator, but now only to buy a portion of the business, not to sell the entire business. So the strategy is the same, but for white knight, you buy the entire business, but for white square, you only buy the proportion of the part of that business. So you're saying that this is where the target company would be taken over by a friendlier company to avoid a hostile takeover, or merge with a friendlier company, i.e. having a defensive what? Merger. That's what we call a defensive merger. White knight involves choosing an attractive predator who buys the entire business. Where white square is a strategy to avoid hostile takeover by choosing a friendlier predator to buy part of the business, only part of the business. Good. And then number 4, another strategy is the use of golden parachute. A golden parachute is all about the target giving attractive retirement benefits to its employees. So in this case, the target company would give attractive retirement package to the top management and employee upon retirement or resignation. Now, this would scare the predator, since the predator would fear taking over the target and all of a sudden require to pay pension benefits to employee who decide to resign, and this would leave the target company as skeleton. Another strategy is the use of poison pill. Use of poison pill. Now, use of poison pill, B being the target and then has been exposed to a hostile takeover, they start using more debt in the capital structure. They approach all the banks. They take 10 million, 40 million from another bank, another 50 from another bank. Now, as a predator, if you acquire that company, who will pay that? Is the predator will pay. Now, as a predator, will you acquire the company? You expected to have a synergy, cost saving. But once you acquire them, you also have to pay all their debts. No. So as a predator, what will you do? You'll just back down. But you're saying that in this case was just a strategy to scare away the predator. That's what we call the use of poison pill. We're saying that in this case, the target would mainly use borrowing to finance its assets, and this would make the target unattractive, since the capital structure mix would have more leverage than the use of the equity. Then number 6, we have the share repurchase option, where the company buys its own share. Then number 7, use of dividend policy, use of legal redress. Legal redress, you just sponsor the minority shareholders. Because we say that in this case, we require a special resolution, 75%. What if 80% they vote for the company to be taken over? So that means there'll be a proportion of 20%. Now that 20%, that's what we call the minority shareholders. They can be funded by the management. If they get to the court and they win, who will win? Is the management who will win? Are you together? Yeah, because actually that strategy, the minority shareholders are usually being funded by the management to go to the court and try to stop that acquisition. Then we have the use of frequent profit forecast, also use of shark reparent. Good. Then we have forms of consideration in case of merger and acquisition. Yeah, you know what's purchase consideration? Eh? The amount that the predator will have to pay to acquire the business of the target. So number one, they can pay in cash. Number two, they can pay through the issue of shares. Also, they can pay through the use of other security, debt security, such as preference share and debentures. Then we have the cash payment. You can do share for share exchange. Also, use of convertible securities. And then we have value gap. What is value gap? Goodwill, correct. We say that value gap is the goodwill, or value gap arises from the fact that the value of the company acquired is totally different from the amount the predator paid. Are you together? Yeah, that the market value and what you pay, they are not the same. That's what gives rise to value gap. So I think that this arises from the fact that the value of the company acquired is different from the true market value. It can either be higher or lower depending on the market circumstances. If it's higher than, the shareholders of the target will get additional benefits. Yeah, in this case, the target, it becomes a profit. It also refers to the situation whereby the amount paid for the merger acquisition of the target is more than the true current market value. Yeah, so what are some of the reasons that gives rise to value gap in a merger? Reasons that give rise to that. That the company is worth 500 million, but you ended up paying 700 million. Number one is poor parenting by headquarters. Number two, poor financial management. Remember, I said that you need to engage the experts. Yeah. Then number three, stock market inefficiency. Yeah, that's another cost, because assuming that in this case you have to buy the shares, you have to buy the shares of B, but at the date of valuation, remember mergers and acquisition, it's not like buying a bread. You just go and pay 50 bob and you go with the bread. So it takes some time. Also, it also needs to be approved. Which authority in Kenya or agency in Kenya approves mergers and acquisition? Yes. Competition of? Sorry? CAK, CMA. Competition Authority of Kenya? Yeah, that's the CAK. Yeah, they can give you a go ahead or they can reject. If it's a threat to the economy, they reject. For example, there was a time Naivas wanted to acquire Nakumat or Tuskys. Then, walikata. Why? You see, the two companies were giant supermarkets, right? So if they are given a go ahead, what will happen to the market? They can form a monopoly, right? Yeah. So there was a time Safaricom wanted to acquire. Which company? Was it you or Airtel? Had given them a good offer. Yeah, lakini si kapana hapana. Because your Airtel is not a small company. A company that controls a share has more than 1 million customers. That's not a small company. Yeah. So in that case, Safaricom, they might be just a monopoly. So in that case, it was rejected. So I was saying that in this case, how does the stock market inefficiency works? Assuming that in the process of the date of valuation, the market price of the target company was 30 shillings. And then for this process to be effected, it might even take 6 months. And then when the deal is done, you find that the market price, remember the date of valuation was 30, but now the market price keep on changing. It can go up, also can go down. So in that case, I assume that at that date, the market price will be 38. Will the purchase consideration remain to be the same? Not remain to be the same. So you might end up paying the premium, or based on the earlier valuation, the market price at the date of now of the paying, it might be totally different. Then lastly, we have over enthusiastic bidding. What is that? That's another cause. This is how that happens. It mostly happens when you have various predators. Now, assume this is the target. Here we have A, we have C, we have D, and we have E. Assume that all these predators want to acquire the target due to some strategic reasons. And in this case, the market value of B is 500 million. So A gives B 500 million, but also C needs this company due to strategic reason. But B has already been given an offer by A, 500. Now, as C, how can you win B? By trying to give them a higher value, right? Higher. C gives them 550 million. Then we have D. Also, D needs A due to strategic reasons. But you see now, B has received a higher offer of 550. As D, what will you do? You also give a higher, right? Higher. Let's assume they give 600 million. Then there is E, a bigger company. Also, due to some strategic reason, you also need B. But B has an offer of 600. So what will you do as E? You give higher. You end up paying maybe 700. But you see the value of the company was how much? 500. But you have ended up paying an amount of 700. Yeah, that's what we call over-enthusiastic bidding. And this normally occurs when the management accepts highest offer in order to acquire their businesses. This may not be the market value of the company. And then lastly, we have reasons why merger fails. Why do mergers fail? Number one is the cultural differences. We can just say what we call the integration problems. Because each company, they have their own culture, how they are used to do their work. Sometimes to integrate that, it becomes difficult. Also, number two, lack of time after merger on the part of manager. Lack of time. For those who have done mergers and acquisition, mostly it's a unit. For those who have done masters on mergers and acquisition, it's a unit actually by itself. After the acquisition and merger, the most critical part is the first 3 years. After merger and acquisition. Because you see, these are two companies, sometimes which are related. How company used to work and how company B they used to work was totally different. So the top management, they are the one to make sure that this company works. But you see now, immediately after acquisition, they don't evaluate that. So what will happen? Mostly they are given the first 3 years, their most critical part, critical years, whenever there is any merger and acquisition. So in case you are not able to control the company, the two companies, the integration for the first 3 years, high chances those companies will fail. And the expected synergy might not be achieved. So that's what you're saying, that number two, lack of time after merger on the part of managers. Then number three, we have the general fear. And this might arise due to technological development. Also, when expected synergy is not, might not occur. Also, political interferences. Also, failure in coordination and communication. Social differences. Also, the value gap. Poor corporate parenting. Also, lack of experience, experts in mergers and acquisition. Good. So kindly go and review those notes again, because it's highly examinable. It doesn't miss. This topic never misses. The part A can be theories, and theories is what we have discussed. And then the other part are the computation. So can you go back to your notes and kindly review what we had written about evaluation of mergers and acquisition? I want us to do some illustration. Yeah, just review what we written on how to evaluate the mergers. Yeah, how do we determine the post-acquisition EPS of the predator? How do we get the non-diluting offer price? How do we determine the non-diluting exchange ratio, so that we can do some illustrations? May 2017, question 5A. May 2017, question 5A. A Limited is considering acquiring B Limited. So that means A is a predator and the B is the target. The selected financial data for the two companies are as follows. So we have the annual sales, we have the net income in millions, ordinary share outstanding, we have the earnings per share, we have the market price per share. Both companies are in 30% tax bracket required. The maximum exchange ratio that A Limited should agree if it expects no dilution in earnings per share. The maximum exchange ratio, assuming that we don't want diluting of share. That's what we call non-diluting exchange ratio. Diluting exchange ratio. Say that, how do we get the non-diluting exchange ratio? So you take the offer price by the predator, then you divide by the market price per share of the predator. And how do we get the offer price? So to get the non-diluting offer price, say that you take the price earning ratio of the predator, then you multiply it by the earnings per share of the target. And you say that to get the price earning ratio, you take the market price per share over the earnings per share, but you're taking for the predator. Now, predator is A Limited. So give me the market price per share of the predator. We have it's 40. Then you divide by its earnings per share. Give me the earnings per share of the predator. We have is 3.5. Then you multiply by the earnings per share of the target. How much is the earnings per share of the target? We have it's 1.5. So give me that. $17.14. Good. So that one becomes the offer price. So therefore, let's get the exchange ratio. You take the offer price, which is 17.14. You divide by the market price per share of the predator. How much is the MPS of the predator? 40. Good. Give me that. $0.43. Good. 0.43. Number 2 of the question. Number 2 of the question. The total premium that shareholders of B Limited would receive at the exchange ratio calculated in A1 above. Total premium. So how do we get the premium? Now I say that to get the premium is the difference between the offer price minus the MPS of the target. Now, we have given them an offer price of how much? 17.14. You compare against their market price per share. How much is the market price per share of the target? It's 15. So the market price per share is 15 of the target, but you're offering them per share will pay you 17.14. So that means per share, there is a premium of how much? 2.1 for that per share, but we need the total premium. We need the total premium. Now in target, how many shares do they have? They have 2 million. So for every share, we are giving them a premium of 2.14, and they have 2 million shares. So that means they get a total of how much in premium? 4.28 me? Yeah, good. That's how we get the total premium. Number three. A limited post-acquisition earnings per share if the two companies settle on a price of 20. A limited post-acquisition earnings per share. A is a predator. Post is after. So after becomes the only surviving company. So how do we get the post-acquisition? EPS of the predator. So we say that you take the combined earnings. That's for both the predator and the target. Let's stop writing. I'll give you time to write. You divide by the number of the predator's shares then you add the number of new shares to be issued. So how do we get the number of new shares to be issued? So that to get the number of new shares to be issued, it will depend on the exchange ratio. New shares to be issued. So that you take the exchange ratio, then you multiply by the number of the target's share. How much is our exchange ratio? This is how we get the exchange ratio iko hapa. Non-diluting exchange ratio, you take the offer price divided by the market price per share. So how much is the exchange ratio? 0.5. Then you divide by the number of the target share. How many shares does the target have? How many shares do the target have? 2 million. So you'll get an amount of 1. So this I will get the exchange ratio. Can you read the question again? A limited post-acquisition earnings per share if the two companies settle on a price of 20. So we say that to get the exchange ratio, you take the offer price. They have settled on a price of how much? 20. You divide by the MPS of the predator. How much was the MPS of the predator? 40. And you get 0.5. Good. So now let's determine this. The post-acquisition EPS of the predator. You take the combined earnings. So give me the net earnings of A and B. We have the net income. So you take 35. Then you add for B, which is an amount of 3. Then you divide by the number of the predator's share. How many shares does the predator have? Hey, how many shares does the predator have? 10. Then you add the new shares to be issued. We have 1. So what do you get? That 8 over 11 is how much? You get 3.45. Good. Lastly, number 4. Number 4. A limited post-acquisition earnings per share if every 50 ordinary shares of B limited were exchanged for 1 8% debenture of a par value of 1,000. Now that's in case of debenture exchange. Say that in case of debenture issue, how do we get the post-acquisition EPS? So post-acquisition earnings per share of the predator, you see that you take the combined earnings, then you deduct the interest on the debt. And remember, interest is allowable for tax purposes, so it should be net of tax. Then you divide by the number of the predator's share. Number of the predator's share. So you take the combined earnings. So these are the combined earnings. So you take 35 and 3. So 35 plus 3. Then we minus the interest on the debenture. And then you divide by the number of the predator's share. How many shares does the predator have? We have 10. Good. Now let's compute the interest. Yeah, do that number 4. A limited post-acquisition earnings per share if every 50 ordinary shares of B were exchanged for 8% debenture with a par value of 1,000. That for every 50 shares we acquire, we issue 1 debenture. For every shares we acquire, but remember we are acquiring B. How many shares does B have? What about 2 million shares will issue how many debentures? 2 of 50 is how much? Let's work with the millions. There it is. Hey, chukua 2 divided by 50. 2 times 1 over 50 ni ngapi? Sorry? 0.04 debentures. Now, these are the debentures. Now, we convert them into monetary terms. So how much is the par value per debenture? 1,000. So that means we issue a debenture with how much? 40 million. So now let's determine the interest. So how much is the interest rate? So we take 8% of 40, which is 3.2, but we think that should be net of tax, 1 minus T. So we have been told that both companies are in 30% tax bracket. So we multiply by 0.7. What do you get? 2.24. Good, so give me that. 3.58. Good. So you can copy now. May 2019, sorry, November 2019. November 2019, question 5. Now, for those who missed the introduction part of what we had introduced, I had already shared with you the notes. I had shared the handout and the notes. Everything is in those notes. November 2019, question 5. Briefly describe the following types of merger. Number one is horizontal merger. What's horizontal merger?
Same industry.
Same industry? Same production? Same industry? Hey, I thought you understood this well. Say that horizontal is where the two companies from the same industry, same level of production, they merge. Vertical is where the companies, same industry, but different level of production. Congeneric, also known as concentric. So the two companies which are unrelated, that means they're in different industry, they merge, but they're offering different products, but they have the same target customer. Then number 4, you have conglomerate merger. And this is where the two companies from different industry, they merge. Part B of the question. A Limited and B Limited are companies operating in the same line of business. In the past few years, A Limited has experienced stiff competition from B Limited to an extent that A Limited is now contemplating acquiring B in order to consolidate its market share. So that means A becomes the predator, B becomes the target. The following financial data is available about the two companies. So we have the annual sales, we have the net income, we have ordinary share outstanding, we have earnings per share, we have the market price per share. Both companies are in 30% income tax bracket. Required. The maximum exchange ratio that A Limited should agree to, assuming that it does not expect dilution in the post-acquisition earnings per share. The maximum exchange ratio. Yeah, that's what we call the non-diluting exchange ratio. But you take the offer price, you divide by the MPS of the predator. And how do you determine the offer price? If you're not given the offer price, this is how you get the offer price. Yeah, it's known as non-diluting offer price. You take the price earning ratio of the predator, you multiply by the EPS of the target. So let's compute that. So price earning ratio, you take the market price per share, you divide by the earnings per share of the predator. Predator is A. Now give me the market price per share of A. We have is 60. Then you divide by its earnings per share, which is 4. You get 15. Then you multiply by the EPS of the target. Target is B. How much is earnings per share? 3. 15 times 3, you get 14. Yeah. So that means, assuming they don't expect any dilution of the earnings per share, they should offer a maximum of 45. So, but now let's get the exchange ratio. So take the price, the offer price, which is 45. You divide by the MPS of the predator. How much is the MPS of the predator? 60. And that is 3/4, 0.7? 0.75. Yeah, what does that mean? See, this one is a share for share exchange. Yeah, 75 is 3/4, right? 3/4 inamaanisha aje? We are doing share for share exchange. That means for every 4 shares we acquire, 3/4, 75%. Can you take 3/4? Do you get 0.75? Yes, that means we are doing share for share exchange. So for every 4 shares we acquire in B, we pay them through the issue of our share. How many shares? 3 shares. That's what it means. Yeah, for every 4 shares we acquire, we issue 3 new shares. Good. Number 2 of the question. The total premium that shareholders of B Limited would agree to receive at the exchange ratio in B1 above, the total premium. So that to get the premium, you compare the offer price, of which the offer price was 45. You compare against the market price per share of the target. How much is the MPS of the target? 30. So the target, the market price is 30, but we are giving them an offer price of how much? 45. So that means for every share, we are giving them a premium of how much? 15. But now you want the total premium. How many shares does the target have? Sorry? They have 3 million shares. So that means you give them a total of 45 million shillings as premium. Number 3, A Limited post-acquisition earnings per share, assuming that the two companies agree on an offer price of 30 shillings. Yeah, A Limited, A is the predator, which becomes the surviving company after the acquisition. A Limited post-acquisition earnings per share, assuming the two companies agree on an offer price of 30. Post-acquisition earnings per share of the predator, you say that you take the combined earnings. Let's get the combined earnings. So you take the net profit. The net income for A is 40. Then you add for B, which is 9. Then you divide by the number of the predator's share. How many shares does the predator have? We have 10. Then we add new shares to be issued. And how do you get the number of new shares to be issued? To get the number of new shares to be issued, you see that you take the exchange ratio, you multiply by the number of the target share. So how much is the exchange ratio? 0.5 times the number of the target share. How many shares does the target have? There are 3, right? Yeah, 3. Half of 3 is 1 point. So many of sorry, 10. A Limited post-acquisition earnings per share, assuming that the two companies agree on an offer price of 30. How do we get the exchange ratio? Is the offer price of which they agree on an offer price of how much? 30. You divide by the MPS of the predator, which is 60. And you get 0.5. That's what I'm using. I'm not using this. You only use this 0.75 if you're not given about what they have agreed, the price they have agreed about. Good. And you get 1.5. So that means the new shares to be issued, it's 1.5. 49 divided by 11.5. You get 4 point. Now let me ask you now a question. Exchange ratio here is 0.5. What does it mean? 0.5. 0.5 is a half, right? What does it mean? And as with the way I was trying to explain there. So for every for every 2 shares, you is it for every 1 share we issue 2, or for every 2 shares we issue 1? Correct. Yeah. For every 2 shares we acquire, we issue 1. And that's what we have done here. The number of the target share, they had how many shares? About so many. How many shares does the target had? See, there were 3 million. Now we are computing the number of new shares to be issued. That for every 2 shares we acquire, we issue 1. What about 3 million shares we are acquiring? How many shares will you have to issue? 3 divided by 2. That's of God, please, 1.5. Good. Lastly, number 4. A Limited post-acquisition earnings per share, assuming that for every 100 ordinary shares of B, the shareholders are offered 2 12% debenture. Yeah, so in this case now, we are not paying the cash consideration, I mean the on share for share. So in this case, it's in case of debenture issue. So the question is, A Limited post-acquisition earnings per share, assuming that for every 100 shares of B Limited, the shareholders are offered 2 12% debenture of 500. So that in case of a debenture issue, you take the combined earnings. And these are the combined earnings. So you take 40 plus 9. But in this case, you deduct the interest on debenture. Then you divide by the number of the predator's share. How many shares does the predator have? We have 10. Good. So now let's compute the interest. So the terms of the issue was that A limited post-acquisition earnings per share, assuming that for every 100 ordinary share of B, the shareholders are offered 2. For every 100 shares we acquire, we issue 2 debentures. What about, remember we're acquiring B. How many shares does the B have? What about 3 million shares? We'll have to issue how many shares? That's 6 over, this is 0.06, right? Debentures. Then you convert it into monetary term, each at how much? Yeah, each at 500. That is 30 million. We determine the interest. Give me the interest rate or the coupon rate of the debenture. 12%. Yeah, so you take 12% of that, that's 3.6, but the interest should be net of tax. So you multiply by 0. Yeah, net of tax, since it's allowable for tax purposes. You get 2.52. So the interest will be 2.52. What do we get? 4.6. Good. So you can copy. December 2010. Question 4B. Kubwa Limited is considering acquiring Dogo Limited, and relevant financial information is as follows. So we have the present earnings, we have ordinary shares, earnings per shares, and then we have the price earning ratio. Kubwa Limited plan to offer a premium of 20% over the market price of Dogo Limited share. So already given the offer price. Required the ratio of exchange, that's the exchange ratio, and the number of new shares to be issued, the ratio of exchange. So how do we get exchange ratio? Exchange ratio is the offer price you divide by the market price per share of the predator. In this case, you're already given the offer price, and we are told that Kubwa Limited plans to offer a premium of 20% over the market price per share of Dogo Limited. So how much is the market price per share of Dogo Limited? We are not given the market price, but we have the price earning ratio. How do we get the price earning ratio? Is the market price per share over earnings per share. So how do we get the market price per share? So to get the market price per share, you take the price earning ratio, you multiply by the earnings per share. So you compute both for Kubwa and Dogo Limited. How much is the price earning ratio of Kubwa? $12. What about for Dogo? 8. Then you multiply by their earnings per share. Give me the earnings per share for Kubwa. We have 2 and you have 1.25. This is 24. This is 10. Offer price. We are given the offer price. We are told that Kubwa Limited plans to offer a premium of 20% over the market price per share of Dogo. Now, the market price per share of Dogo is 10. Then they are planning to offer a premium of 20. So you multiply by 120. You get an amount of 12. That will be the offer price. Good. So that means the offer price is 12. You divide by the market price per share of the predator. How much the MPS of the predator? Is how much? 24. So that's what we are computing here, the market prices. 12 over that one, you get 0.5 or a half. Good. So that was number one. We have not answered everything. We are told that number one, the ratio of exchange. So the exchange ratio we have is 0.5, or for every 2 shares, we issue 1 new share, and the number of new shares to be issued, So how do we get the new shares to be issued? You take the exchange ratio times the number of the target shares. Exchange ratio you have it's 0.5. You multiply by the number of the target share. How many shares does the target have? 800. So that means you'll have to issue how many new shares? 400. Number 2 of the question. The earnings per share for the surviving company. After the acquisition, the surviving company is the predator. So the earnings per share for the surviving company immediately following the merger. So that's the post-acquisition EPS. So you take the combined earnings divided by the predator's share plus new shares to be issued. We take the combined earnings. So we have the present earning for Kubwa, which is 4,000. Dogo, it's 1,000. You divide by the number of the Predators share. They have 2,000 share. Then you add the new shares to be issued. We have it's 400. 5,000 divided by 2,400. $2.08. Lastly, number 3. If the price earning ratio of Kubwa Limited stays at 12 times, determine the market price per share of the surviving company and explain what would happen if the price earning ratio fell to 11. Yeah, if the price earning ratio of Kubwa stays at 12, determine the market price per share of the surviving company. So how do we get the post-acquisition MPS of the Predator? Yeah, the MPS is the same. Price earning ratio times earnings per share. But in this case, now you'll take the price earning ratio of the Predator, that's the surviving company. Then you multiply by the post-acquisition earnings per share. So you're told that if the price earning ratio stays at 12, and when it falls to 11, you compute the market price per share. So you take the price earning ratio, then you multiply by the post-acquisition EPS. How much is the post-acquisition EPS? 2.08, 2.08. What do you get? $24.96, 22.88. I will read that question again. If the price earning ratio of Kubwa Limited stays at 12 times, determine the market price per share of the surviving company, of which we have is 24.96, and explain what would happen if the price earning ratio falls to 11. So what has happened when the price earning ratio reduces? What has happened to the market price per share? It also reduces. Yeah, you write that. So you can copy. Open December 2022. Question 5C. Part B of the question. Let's start with part B of the question. The International Monetary Fund has implemented many reforms in recent years designed to strengthen its cooperative nature, improving its ability to serve its membership. In the context of above statement, propose 4 main reforms that have been designed by IMF in recent years. Yeah, those are what we call the emerging issues and contemporary issues. Now, there was a student some time back, aliniuliza, teacher, how to prepare notes za emerging issue. Emerging issue is not, that one, it's not a topic. Are you together? Emerging issue, they can test anything on what is happening. Kwambia hiyo sio topic, sasa tufanye nini? Nikamwambia sasa, sasa utakujibu aje? Yeye anataka hizo notes. Nimwambia that one is not a topic. Then akaniuliza hii swali. Nikamwambia surely, since you have used internet kuni text, so you can use the same data to Google. You know, those are the information in the internet. You know, kuna maswali zingine student anaulizanga unashangaa. You have access to internet. You know something relating to merger directly. Kama mtu anaweza niuliza what's the difference between a white knight, amekutext, hayuko physical class, amekutext. Now the question is, you know, this being a professional field, academics sometimes inasaidianga degree, because if I was a lecturer out campus, I could be only doing that 30% of the work. Hiyo ingine namwachia nyinyi na Google. Because someone before kuuliza different ya hii na hii. So first of all, enda kwanza Google, get the information, even you can get much better explanation than what I'll give. Some information don't expect that mwalimu akuwe na kila kitu kwa kichwa. All these information are the internet. Niulize hesabu nitakusaidia. Lakini viole zingine sasa kama hii alinsist nimpe points. Aka Google akaandika 15 points. Kaambia sasa mimi angeniuliza ningekupea tu bili. But you see now you have increase on your on your research. Yes. So emerging issue is not a topic. Emerging issue, they can test anything in this world of finance. Kwa hivyo mkuu updated on what's happening. Yeah, those are the current trends. Let's go to part C of the question. Alpha Limited and Beta Limited are companies operating in the same line of business. In recent past, Alpha Limited has experienced very stiff competition from Beta Limited, such that Alpha Limited is considering acquiring Beta Limited in order to consolidate its market share. The following financial data is available for the two firms. So we have the annual sales, net income, outstanding number of ordinary share, earnings per share, market price per share. Both companies are in 30% income tax bracket. Required, number one. The maximum exchange ratio that Alpha Limited should agree if it expects no dilution in the post-acquisition earnings per share. So exchange ratio will take the offer price over MPS of the predator. And how do we get the offer price? You take the price earning ratio of the predator, you multiply by the EPS of the target. So price earning ratio. So give me the market price per share of the predator. So the market price per share we have it's 30. Its earnings per share we have is 3. You multiply by the EPS of the target, which is 10 times you get 20. So the offer price will be 20 over the market price per share of the predator, which is 30. That's 2 over 3. 2 over 3, that's to that. To that is 0.67. Good. Number 2 of the question. Alpha Limited post-acquisition EPS, if the company agree on an offer price of 40 shillings. A Limited post-acquisition, that's the post-acquisition EPS of the predator or the surviving company. You take the combined earnings, you divide by the number of the predator's share, plus new shares to be issued. So you take the combined earnings. So you have the net income 150. The other one we have is 20. You take the number of the predator's share 50 plus new shares to be issued. New shares to be issued, you take the exchange ratio times the number of the target's share. So the exchange ratio, we are told that, assuming they agree on an offer price of 40. So that means the exchange ratio, we say that you take the offer price, which is 40, you divide by the MPS of the predator, which is 30. 4 over 3, you get 1.33. So the exchange ratio will be 1.33 times the number of the target share. How many shares does the target have? 10. And you get 13.3. So the new shares to be issued, it's 13.3. 170 over 63.3. 2 point. Number 3, Alpha Limited post-acquisition earnings per share. If for every 200 ordinary shares of Beta Limited are exchanged for 5 units of 10% debenture. So that in case of a debenture issue, to get the post-acquisition EPS, you take the combined earnings. Then for the debt, you deduct the interest net of tax over the number of the predator's share. So you take the combined earnings, so that's 150 plus 20. Then you deduct the interest. You divide by the number of the predator's share, which is 50. We determine the interest. So that Alpha Limited post-acquisition earnings per share, if for every 200 ordinary share of Beta Limited are exchanged for 5 units. So for every 200 shares, they exchanged for 5 units of debenture. What about, how many shares does the target have? What about 10 million shares? They'll get how many debentures? 50 over 200, that is 0.25, right? 0.25 million debenture. Then you convert it into monetary terms. How much is the par value? 500. That's 125, right? So 125 million. So how much is the interest? So the interest rate was 10%. 10%. So it's 10% of 125, you get 12.5. But the interest should be net of tax. So you multiply by 0.7. You get 8.75. So 8.75. So give me that. 3.225. Lastly, number 4. Combined operating profit, that's ABIT, and the post-acquisition earnings per share at point of indifference between earnings per share and a financing plan C2 and 3. Point of indifference. What do you mean by point of indifference? We did capital budgeting. When NPV is positive, we accept. When NPV is negative, you reject. When NPV is 0, muliandika nini? Point of indifference inamaanisha aje? Naona muliandika tu. Point of indifference, that means you can either accept or reject. Yeah, because both of them, they are giving the same outcome. The inflow and the outflow are the same. So at point of indifference, this is where the option you have, they have the same outcome. So at point of indifference, the earnings per share for option 1 is equal to the earnings per share for option 2. Option 1 in this case was when they do a share for share exchange. The other one was when, in case they issue a debenture. So now they want the operating profit. So how do we get that? We'll come to cover this later. How do we get the earnings per share? Now, in case of equity financed, earnings per share, you take the EBIT 1 minus T over the number of shares. The other option was in case of debt. So in case of debt financed, earnings per share, it's EBIT. For the debt, you pay the interest, then you tax to get the earnings after tax, and then you divide by the number of shares. Yeah, I shall cover this one also in the financing decision. Now let's start with option 1. In case of share for share exchange. So you'll take the EBIT, which is unknown, that's what we are computing. 1 minus T, that is 0.7 over the number of shares. So in this case, the number of shares, the printer had 50, then was to issue an additional 13.3. So how many total shares do we have? 63.3. So this one is equivalent to 0.7 EBIT over 63.3. In case of debt finance, you take the EBIT minus the interest. Here is the interest. The interest was 10% of 125, which was what, 12.5. So you minus 12.5